this is Adam Thomas here. Welcome to the free video for Skyview Trading, and I wanted to show you an earnings trade I did in Facebook. So I saw a lot of tweets on Twitter about people trying to buy calls on Apple and Baidu and all kinds of these stocks because they think it's going to make a move like Google. So basically they're just betting on, they want to make that 1,000% or so that you could have made on Google if you were long calls. But you have to realize that a move like this on Google happens statistically 1% of the time. So basically for every shot you take, by the time you do hit the home run, you're barely going to make back all of your losses that you had on the other trades because you were buying all this premium and the next day the stock opens flat to slightly up or down, and you're basically getting crushed on the volatility. So I shorted calls on Google. I ended up losing like $300. It was a defined risk trade, meaning I shorted calls, but I also bought calls further out to protect it. So I lost 300 bucks. No big deal considering I've consistently been doing these earnings trades. So I wanted to just show you what I'm currently doing on these earning trades. So here's Facebook, and if you look at these options here, these are the weekly November options, and you can see I'm short the 43 put and I'm short the 57 call. The expected move is $5.21. You can see we are up $4 right now. Actually a little bit less than $4, so we stayed within the expected move. I could have sold options at the expected move, so 49 plus 5 would be 54. You can see those were trading at $1, and that still puts your break even at 55 on those. And on the downside, I could have sold the 44. So there you would have taken in a credit of $1.78, and then of course if you want to define your risk you have to buy your wings, so that's going to take off a little bit of premium. But your break even is going to be, on the upside it's going to be 54 plus $1.78. On the downside it's going to be 44 minus $1.78. But I typically play it safe. I like to go further out and give myself a higher probability of success, so you can see these options remain out of the money. So a good way we can kind of judge where these options will open up and see kind of what we're working with in Facebook is to come to this layout drop down menu and click Theo Price Mark. So if you look at this tool here, you can see the date, the stock price adjust, and the volatility adjust. Now we're going to look at these expiration months, and you can see the weeklies, the implied volatility is 162%, and you can see the average volatility on these back months is around 60%. So it's pretty evident that tomorrow when these options open up, this implied volatility is going to drop off and be only around, it's going to be probably 80%, 90%. So what I'm going to do is I'm going to play it safe and just say it's going to drop 60%. In the volatility adjust, I'm going to type minus 60, click enter, and we're going to change the date to tomorrow morning. And the stock price adjust, you don't have to do anything because it automatically updates to the mark price of the stock. So if we look at this, these options we're trading at, and I'm looking at the 43 puts, these puts were trading at 54 cents. If we open right where we're at tomorrow, these options are going to be at 13 cents. And this is theoretical, of course. And you can see the theoretical price on the short calls we have will be at 0. So basically we'll be able to buy back this spread that we're currently in. We'll be able to buy back the short strangle for probably 10 cents or less. So that's what I'm going to shoot for tomorrow. I'll go ahead and put my nickel bid in, and I'll just go ahead and do that now. So we'll click the ask of the call, and I'm going to put in a bid for 5 cents. Good till canceled. And we'll do this for the put side as well. So the reason I'm doing it for a nickel is because with TD Ameritrade, if you buy a short option back for a nickel or less, they don't charge commissions. So it's kind of just an incentive to go ahead and take your risk off the table. So there we go, my orders are in, and hopefully Facebook remains where it's at, And you know, if you've been trading earnings, you've been buying options for earnings, just realize that over time, if you consistently do that, you're going to lose money. Obviously, Google was an outlier, and you know, stocks do make that kind of move, but it's only 1% of the time. So just be aware of that. You're not going to hit a home run. So hopefully you'll realize that that's not going to be a profitable strategy. If you'd like to learn some of these earnings trades and how I'm trading them, you know, just shoot me an email and I'll gladly, you know, help you out. So, alright guys, hope that helps, and I'll see you on the next update.